Good morning or good afternoon, and welcome to our August 2025 quarterly macro and markets update featuring our Chief Investment Officer, Michael Dow. I am Julien Frazeau, Deputy Chief Investment Officer here at Pointe, and I have the pleasure of serving as your host and moderator for today's discussion. So we have a packed agenda full of timely insights. So before we dive in, just a few quick housekeeping notes. We have set aside 90 minutes for this discussion, and we have more than 90 slides and a broad range of topics. So we will proceed at a steady pace. Many of you have already submitted excellent questions in advance, so thank you for that. But we also encourage you to submit questions during the session via the Q&A box at the bottom of your Zoom screen. We will address as many as possible throughout the presentation. Also, note that our colleague Nick Coletta is also present on the call to directly address in the chat any highly specific or technical questions you may have. A full recording of today's webinar will be available within 24 hours at beaconpoint.com/videos, so you can revisit any portion of the conversation at your convenience. Here is what we'll be covering today. We will begin with a review of a volatile quarter, including a sharp rebound post-Liberation Day. Next, we will analyze how AI-driven productivity gains and earnings trends have helped sustain economic momentum. Michael will then explore the latest tariff developments and take a detailed look at inflationary pressure and labor market dynamics. Next, we will revisit the US debt and deficits, including the fiscal boost from the One Big Beautiful Bill and implications for the US dollar's reserve currency status. We will discuss potential Fed Reserve's actions and the broader monetary policy outlook. And finally, we will conclude these strategies for positioning portfolios after the significant market rally. With that, let's get started. Please join me in welcoming our Chief Investment Officer, Michael Dow.
Thank you, Julien, very much for that kind intro. We have a lot of slides to cover today. Please don't hesitate to throw your questions into the chat, and I look forward to having both Julien and Nick on hand here to answer the questions. I always start this presentation by reminding the group what matters most when thinking about how to take risk and where to invest and what the most important thing is when investing. And the answer almost always is, let's get right what the Fed cares about, and let's try to figure out where we are in the economy. So what does the Fed care about? Economic growth and inflation, and where you are in the business cycle always tells you about the growth rate of profit margins and, frankly, earnings. And that's the key. If you can get the economy, inflation, and corporate profits right, and at least make some judgments about them, I think it's a lot easier to position portfolios for downside protection and to take advantage of the opportunities that we find during our rigorous quarterly macroeconomic and asset allocation process. Let's start with a conclusion. So our economic outlook, we've talked about this for 2 years now. Are we in for a no landing, a soft landing, or some kind of a recession, or maybe a stagflation environment? What's it going to be? And as it stands for the last 3 quarters, what we've been thinking is that we were likely to have a whiff of stagflation with a small s. For those of you who remember the 1970s, stagflation with a capital S was a very devastating period of time for risk assets. Both stocks and bonds did very poorly in the 70s and early 80s until Paul Volcker was able to get a handle on inflation, and it set us on this 40-plus year period, almost a golden age of investing, because we've had interest rate volatility made very low, and economic volatility. We haven't repealed the business cycle, but the last 40 years have been a really good time to invest because economic volatility has been low and inflation volatility has been low. So now we're back. There's been some inflation, but it's not likely to be anything like the things we saw with the supply shock, particularly the oil supply shock back in the 70s. So a whiff of stagflation is our cyclical economic forecast, and we expect to see that for the next couple of quarters. What about the Fed? The Fed's on pause and has been for almost a year, but they're going to resume the rate cutting cycle in September at the middle of September meeting. They're going to restart it because they're going to need to support the economy. And if you recall, the Fed's job is to balance total or full employment and price stability. And those two things are diametrically opposed to each other. So you can't do both at the same time. You can't maximize employment and keep prices stable. So the Fed needs to prioritize one or the other. And by September, given some of the numbers we've seen recently, particularly in the labor market, they're going to prioritize the labor market over a potential transitory tariff inflation burst. So we should see the Fed back to resume. We should see the Fed resuming their the rate cut cycle starting in September. In terms of the trajectory of corporate profits, especially in some of the industries we'll talk about, AI, the Magnificent Seven, growth stocks in particular, there's been a solid momentum in growth. And we expect that to continue barring a significant economic slowdown. So once again, it's the answer to these questions that help us to understand how to position the portfolio. What's not on the list? Politics themselves, policy noise. That is, we have to be able to sift through the noise coming out of both the fiscal and monetary authorities and figure out what the signal is. And frankly, nothing that you see on TV is probably going to be terribly helpful when it comes to achieving your longer term financial objectives. So in an effort to level set, because the conversation today is going to be about macroeconomics, policy, markets, et cetera, it's good to know kind of where we've gotten to here a little bit past the middle point of the year. In terms of returns, U.S. stocks are up 11% and non-U.S. stocks are up 22%. That hasn't happened in a long time. It's also a pretty good argument for a diversified exposure to global stocks, because sometimes international stocks do outperform the U.S., particularly when the U.S. dollar is declining. What about interest rates? Well, they're kind of pricing in a bit of a slowdown now. You've got 10-year yields at 4.2, although mortgage rates have come down a little bit, not enough to get a lot of people excited about the housing market, which seems to be in a bit of a funk. Whereas 2-year yields, which is a much better indicator of where the Fed's going, have come down considerably, particularly in the last week or so since the labor market report that we saw a week ago Friday. 2-year yields 3.7, 10-year yields 4.2. Volatility is something we take a look at. It spiked during the Liberation Day tariffs. It was up 200% from the levels we saw at the beginning of the year, but is now lower than it was come January 1st, about 16% lower. So there's a fair amount of complacency in both the stock market, which is represented by the VIX, and bond market volatility or interest rate volatility, which is captured by the MOVE. Both of those things are exceedingly low and are way down versus the beginning of the year. This is good news in some respects, but not good news in others. What I mean by that is volatility, when it's happening, feels very badly, but it also creates opportunities. And when volatility is at levels that we're seeing now, it indicates potentially an unhealthy level of complacency in markets. So where are we seeing some big returns? Things like commodities and Bitcoin. So Bitcoin and gold are both up about 28 or 30%, whereas oil is down 13% since the beginning of the year. So stocks higher, rates are pricing a slowdown. Volatility is very low, and the dollar substitutes, which would include Bitcoin and gold, are up substantially. What are we seeing in terms of the global macroeconomic environment? These are the slides for the next couple of 3, 4 that we always present to try to lay the groundwork and see what the landscape looks like for global macro economic environment, so we can get a sense of where we should be placing our clients' money. Interestingly, global services have taken a real jump here, whereas global manufacturing is now just barely into contraction rate. Global services, nice little bump here. If you're looking for country by country, well, here's the global heat map. Over here, you're seeing May, June, July. The numbers are going from orange to green, so that's good news. It seems like a very supportive global economic environment. The U.S., in fact, is a pretty big bright spot in a strongly green area. The U.S. economy seems to be doing pretty well right now. Developed markets recovering, and emerging markets recovering from what was back in April and May during the Liberation Day tariff volatility, not looking good for emerging, but now looks pretty good. So how is all this possible? Well, most of it's because of monetary policy accommodation. For several years after March 2022, all the central banks around the globe, particularly the Fed, were raising interest rates. But now what you're seeing in both emerging and developed markets, cuts across the board. So in the last 12 months, there's been 122 central bank rate cuts in developed markets and 66 rate cuts in emerging. And just in the last 3 months, the number of cuts versus the number of hikes, very little hiking activity. And that's generally in, for example, Kazakhstan, and I believe Argentina also maybe raised rates, but those are heterodox countries and we can safely ignore them. The world is on a global rate cutting cycle, and we expect the Fed to resume their cycle here in the US come next month. Where are interest rates here in terms of emerging market central banks? So they've come down 120 basis points since the peaks about 2 years ago. And here in developed markets, these are different scales from almost 4% to just over 2%. So all the central banks are doing the best they can to support global growth. And taking a little bit of a deeper dive into the U.S., Nick's put together what I consider to be a pretty handy cheat sheet for the macro economy here in the U.S. Real economic data, including GDP, inflation, the Fed's preferred price index, personal consumption expenditures, unemployment rate, budget deficit, housing, et cetera, and some market data. This is from February. I put it here in order to indicate that in February of this year, right after the turn of the year and after the inauguration, a lot of things were looking pretty good across both the market data and the real economic data. But fast forward to August, and we've got a different story. Things are different. They're less sanguine. They're less positive. There's been a lot of policy uncertainty. The tariff impact on growth and inflation, which hasn't been fully realized, has caused participants in the economy, households and businesses to hold off on purchases to a certain extent. We're seeing a little bit of disruption in labor markets and things. So it's not as rosy as it was 6 months ago. However, when we last spoke in May, it was our contention then, and it remains our outlook now, that most of the bad news has gotten out of the way, and that some of the clouds that representing policy uncertainty are starting to clear, and that the passage of the One Big Beautiful Bill is likely to provide a pretty meaningful boost to growth, particularly by not causing what would effectively be a pretty sizable tax hike on consumers with the expiration of the TGCA tax cuts of 2017. Those have been made permanent. The tax cuts have been made permanent. And furthermore, and this is what you're seeing on a lot of earnings calls this quarter, is a number of companies are mentioning the positive benefits of particularly accelerated depreciation on the corporate profit outlook. So OB3 has got some pretty nice growth things going on for the economy. Inflation we haven't seen it yet, but it doesn't mean it's not going to happen. Hasn't seen a bump yet. It's expected in the next quarter or two from tariffs. And there's other policies that have implications for growth, inflation, and the debt. And we're going to go through them in some detail in a moment. But first, a deeper dive into GDP. The only thing stimulative when you're disaggregating GDP into C plus G plus I plus X, which is C is consumer, G is government spending, I is business fixed investment and exports is, X is net exports. That's imports minus exports. What do you see in here? Well, almost everything is looking a little weaker heading into 2020, the second half of 2025. And we've got some key questions that need to be answered before we can come to some conclusions about where we're headed. But how and when will this policy uncertainty that we've seen be resolved? Again, I mentioned we've already seen a bit of a smoke clearing here on a lot of it. We've gotten through the initial shock of some of the tariff announcements. We're becoming a little desensitized to it until there's a strong bump in inflation, or if we're seeing higher costs that then slow the economy further, which are part of our stagflation with a small s outlook. It's not a recession. It's not hyperinflation. It's not the 1970s. However, things were really rosy coming into 2025. I would say the administration had a little bit of house money to play with in terms of their ability and willingness to promote growth and inflation unfriendly policies. And so far, it hasn't had a negative impact on markets. So, in fact, we're seeing all-time highs, record highs in the stock market, many of them in the last few days. So, this is the key: is getting some of these trade deals done, getting the uncertainty out of the way, and figuring out if we can avoid a recession. What are the effects of tariffs on growth and inflation? We're going to dig a little deeper into that in coming slides. And I already previewed some of the growth positive policies that are in the pipeline from OB3. I think they're really important and are contributing tremendously to the stock market record highs. And what's the Fed going to do? Again, these are the key questions for the second half, and we're going to try to dig right in. Let's look at some numbers to again lay the groundwork. We had a disappointing first quarter GDP number at a negative 0.5. We saw a pretty big bounce back in the advanced number. We're going to get another release for GDP in a couple of weeks here in August. That's the second look. The final GDP, it'll be revised, and the final number will be available at the end of September. But -5 to +3, that's a bounce back. It's a bit of a recovery. The more normalized levels are about 2%. So right now, most economists are looking at half of potential growth for the next 2 quarters, and then a slow recovery to trend growth, which is about 2%. The potential GDP of the U.S. in terms of real growth is about 2%. We should be about half that. We don't expect a recession, but we don't expect an acceleration in the economy, given what we've seen in the first half. So. What's important, though, to think about isn't this 3% GDP number, or even this -1/2. This is GDP in the orange line. The blue bars are a better estimator of trend economic activity in the U.S. They're real final sales to domestic purchasers, and they remove the volatile components of inventory and net exports. You take out inventory, net exports, you get real final sales. And that number, unfortunately, is looking a little more negative from an economic trend growth perspective. So this is part of the reason why we feel pretty confident we're going to see a slowdown in the second half, but these numbers aren't negative yet, so probably not a recession. Putting it all together, you've got GDP on the left, inflation in the middle, Fed funds on the right, looking out through from today, which again, here's your 3% GDP. Inflation came in at the end of second quarter at 2.7. Expect inflation to bump up for a couple of quarters and then resume its downward trend towards the Fed's 2% target. The Fed, we feel, is going to likely look through any transitory inflation bump from tariffs. It's a one-shot deal. It's not a persistent change. That's the view on K Street at the Fed. So rates should be normalizing to whatever R star is, which could be a couple of 1 or 2 rate cuts from here, or it could be 4 or 5 rate cuts from here. That's a very challenging notion. We've talked a lot about what the neutral rate of interest is, and we'll talk about it again when we look at a monetary policy scorecard. So likely to see a small bout of stagflation over the next couple of quarters, with the Fed resuming rate cuts in September as they prioritize labor markets over transitory inflation. We look at a lot of data. This is U.S. GDP is the 3% we just talked about. We look at Atlanta GDP now to try to figure out where next quarter is headed, and as a real-time indicator, whereas you only get GDP data every quarter, but Atlanta GDP now calculates a bunch of economic data series that are calibrated to calculate GDP or forecast GDP going forward. And we also look at city surprise indices. These are also pretty supportive. So the economy has been resilient so far, but there's policy uncertainty that remains. Julian, did you have a question?
Yeah, and there's plenty of questions. And the one I think is timely is how do we do economic forecasting and then financial planning, of course, when your policies and thinking of tariff in particular change all the time?
So we are incorporating new information all the time when trying to assess how to invest client assets. Financial planning is a much more longer term process. And it's important to remember that there's always a new administration, or generally a new administration every 4 years. Policies change. Getting a long-term financial plan, or having, for institutional clients, an investment policy statement that has a long-term investment horizon is the most important thing any of the folks on the call can do, and that is remain focused on the longer term. So policies are important to try to assess the short run economic inflation and corporate profit dynamics. And how do we do it? We do it on a quarterly basis by getting a bunch of very skilled investors with deep backgrounds in economics, capital markets, and asset management experience, and keeping on top of all the literature and the research, and trying to make reasoned judgments that hopefully can provide insights as we build portfolios. But the key point here is, and I want to make this really clear, there is no massive asset allocation changes that you should ever expect or should want from your advisor based on an economic data point, a policy change, a tweet, or even an entire election. These things tend to have transitory effects on things. The most important thing is getting the long run, is being invested, fully invested at your proper risk profile, and then staying invested as things develop. Anything else, Julian, on that?
Well, I guess there'll be plenty more later, but yes, there's a lot of questions, about, is it time to go to cash?
Oh yeah,
The market
no.
has been up so much.
Yeah.
But you already addressed that one.
Yeah, well, so I'll just reiterate. I mean, the answer is determine what your risk profile is, get a financial plan together, and then build a portfolio that respects the financial plan by quantifying your risk profile using a benchmark. That's a big mouthful, but what it means is make sure that you're invested like institutions are invested if you're a private client, and know if you're an institution that we've got the state-of-the-art risk modeling tools available to help you achieve your objectives. But no, never go to cash. That's a very bad strategy, because it requires that you make two perfect decisions. One, to get out of the market when you think it's at a peak, and two, to actually make the harder decision to get back in at some bottom somewhere. So no, cash is the illusion of safety. Don't do it. Yes, Julian.
Yeah, and there's a lot of questions, but you'll address them later. But just to preview, people asking about the quality of the data and what happened with the BLS. So we'll address that. So
yeah, well, I'll for sure get to that. That's a big story. So anything, let's talk a little bit about how, again, back to the question, how do we do macroeconomic analysis and forecasting? Well, part of it is disaggregating the data and reconstituting in ways that will help us, forecast better. This is just a tool we use. It's a heat map that's got some of the major economic indices that can, again, help us identify turning points. Leading economic indicators, financial conditions, inventory, and sentiment are the key here. And financial conditions, very positive. This is market data that represents the cost of funding in the U.S. economy. Looks pretty good right now. The only what I would call red marks on the chart here are the fact that inventories are building. That is, sales haven't been as high as they have been in the past. So the inventory to sales ratio is flashing a red signal. And sentiment has been a bit of a drag. And a lot of that came from all the headlines in March, April, May, the initial tariff announcements, some of the other policy implementation was a little bit chaotic. It was, for some, big change all at once. And that generally has a tendency to cause sentiment indicators to decline. And you can see consumer sentiment has started to recover a little bit, but home builder sentiment remains in the doldrums. Bottom line, and I'm going to jump ahead to a couple of slides here, the recession probabilities are down to 35% from 40% a couple of months ago. And again, we just think that the outlook looks like a whiff of stagflation. Nick does a lot of analytics and has put some charts together here. I'm just going to say this takes the aggregate macroeconomic data series that we just looked at and puts it into one single time series. Not a strong signal. Nice little recovery from mid-year, and so now it's a very neutral signal. Again, that's why we're a little more sanguine about the outlook and the fact that we don't think there's a recession coming. Disaggregating the macro data into its components. So again, financial conditions, leading economic indicators, sentiment, and inventory. No strong signals from any of these, but for what I would call, again, a recovery in sentiment. So there are some nice tailwinds to the U.S. economy. And we think they're going to be realized. As I mentioned, actually the probability of recession is at 35, down from 40. So 1 in 3 chance. That's about a double on the historical average. Historically, there's generally about a 20% chance of a recession coming in the next 12 months. So we're a little bit elevated in that regard, but it's moving in the right direction. I don't want to go into too much detail about sentiment because I think that's something we've talked a lot about. But since the inauguration and frankly since COVID, consumer sentiment has declined, and the expectations for the future of consumer sentiment have also touched 30 or 40-year lows, but then they've recovered. So again, we had a bout of what I would call negative headline news in the first half of the year. There was a ton of economic uncertainty and policy uncertainty, and some of those clouds are lifting. And it's important to note one thing: kind of depends on which team you're on, blue or red, whether your outlook for the economy is plus or minus. So if you're a Republican, you think the expectations for the consumer are great, and if you're a Democrat, not so great. But that's been the case since Obama, basically, this bifurcation. However, this has been one of the larger bifurcation. So just keep that in mind when looking at sentiment data. You can explain almost everything about sentiment based on your political affiliation. Not a great way to manage money, by the way. Again, politics don't matter, policies do. So we focus all of our attention on policies, and we're going to dig in a second. By the way, while we're talking about policies, it's important to remember everything should come back to how it affects GDP growth, because GDP growth is your best indicator of longer run economic outcomes and market outcomes. If the economy is growing, the market should go up. If the economy is in a recession, it's likely going to go down. So let me just show you this quickly because it sets the stage, and it answers a lot of questions about why are we talking about total factor productivity, or why do we talk about labor force growth? And the answer is because if you combine, this goes back to the 50s, by the way, every single decade, GDP growth and the drivers. What are the drivers of GDP? It's not complicated. It's a tautology. It's an accounting function. Labor force input plus total factor productivity equals GDP. Growth in workers plus growth in real output per hour, which is TFP, is GDP. So going back to the 50s, GDP was over 4% because labor force growth was 1.2, and it was a highly productive decade at 3.1% growth in total factor productivity or output per worker. So just to put our potential GDP as a country has come down as the economy's grown and remains the largest in the world. But right now, what we're looking at is a potential policy mix that might affect positively total factor productivity and probably negatively labor force growth. And we'll get into that in a second. But when you have a demographic drop off, potential GDP goes down, and we don't want to see that. We want to see GDP, 2 to 3%. Potential's at 2%, and that could be any combination of 1% total, 1.5% total factor productivity, 60 bips of labor force growth, or some other. But just keep in mind when we're talking about labor inputs and total factor productivity, it's because if you add those two together, you get GDP. So let's dig into and update the group on where we see the policy priorities of the administration and where do they stand. Well, right now, border tightening's been pretty much a fait accompli. I think we're going to see more on tightening up the border, but crossings have declined dramatically. The percentage of foreign-born workers is in the workforce as a growth rate has now turned negative for the first time, and it's lower than native-born increases in the workforce for the first time in 5 years. Trade policy is just continuously updated. I can't even keep up, quite frankly. So good question. How do you manage all that when you're trying to manage the money? Answer, you just kind of try to find the signal from the noise here. And the signal so far on trade policy has been if it's damaging to either the bond market or the stock market has a revolt, it's likely to be reversed. So that's good news. So I mentioned 6 months ago, actually 8 months ago now, it was the December 2024 webinar that cost cutting is likely not to be a successful policy because it's impossible for an organization or a department like DOGE to do what it needs to do if the goal is to reduce the deficit materially. The deficit's $2 trillion. You can't do it without touching the entitlement. So I'm going to give that one just a red X right now. These are growth negative policies. When you're kind of torturing the Fed chairman on social media by pressuring him to lower rates, that's not good for growth. Cost cutting is not good for, surprisingly, it's not. I mean, it's basically fiscal adjustment. It's reduced government spending government spending is part of GDP. Trade policy uncertainty, probably growth negative. Immigration, when you're lowering the labor force, it's going to be growth negative. What are the growth positive policies? These are, by the way, all of these policies on the top half of the chart got out of the gate, and the administration tried as best to implement them as possible in the first 225 days of the administration. So you get all the bad, or headwinds to growth out of the way. Now you've got the OB3, or the one big beautiful bill, which extended the tax cuts, massive incentives for business investment through depreciation policies. And we still have deregulation of the energy and financial systems to come that are all likely to contribute to a nice, corporate profit environment going forward. So these likely growth positives are the part of the reason, again, why we're fairly confident we're not going to see a recession in the next couple of quarters, because get the bad news out of the way in the first half of the year, you got the good news coming. In fact, just to put a fine point on the labor force composition and foreign versus native born, as a percent of the population, native borns increased from 80 to 81. As a percent of the U.S. labor force, foreign born has gone from 20 to 19, but having grown 5% since 2010. So most of the labor force growth in the U.S. over the last 20 years, by the way, has been driven by foreign-born workers. You can see it on this chart. But the growth rates now have crossed. So green is the growth rate of the average foreign-born growth rate here in the labor force, whereas the orange is the average native-born. And again, they just crossed over in the last 90 days or so. So it's the first time in 5 years that native-born employment is growing faster than foreign-born. And just to circle back on the Doge comment, and how to basically fix the budget deficit. It isn't going to happen through the slashing discretionary spending. Discretionary spending is what Congress appropriates on an annual basis, and it's where it was the target of the original Doge effort. But you can't, because it's called discretionary, because sometimes you can change it, and you can change it based on Congress appropriating less the next year. But once it's appropriated, it probably should get spent. But where you really see the big wood to chop, so to speak, on getting the deficit down has to be in the mandatory spending categories. Mandatory spending, this is, by the way, fiscal year 2024 total outlays of the government, just under 7 trillion, whereas revenues are just under 5 trillion. So you have this $1.8 trillion budget deficit for fiscal 24, which is, was over 7 months ago, or now 9 months ago. $4 trillion in mandatory spending, 1.5 of it's Social Security, 1.1 is Medicare, 618 is Medicaid, and some other income security features. So this mandatory spending is where the work needs to be done. It's impossible to put a dent in the deficit unless you go there. So again, these are the things that I think came about and maybe were negative, a little bit negative for the economic outlook and for markets, which seems to have shrugged them off, because markets are now focused on the growth implications of particularly the one big beautiful bill, which just extending the tax cuts is likely to be pretty positive for GDP growth. In 2025, it should add a couple of tenths, but over the course of the next couple of years, by increasing disposable income for the consumer, which is 2/3 of the economy, you're likely to see a pretty nice bump, depending on who you're asking, the Tax Policy Center, or the Yale Budget Lab, or the Tax Foundation. By year, it looks to be, almost worth a percent of GDP growth by 2027. So it's not all good news by lowering taxes. If you don't get these positive growth benefits, you know for sure that less revenue increases the budget deficit, and you need to balance the two. Economics is all about cost-benefit analysis. The cost of the tax cuts is the increasing budget deficit and the potential for higher yields as government debt crowds out private issuance and private funding. So that's what we're looking at. But all in all, if you look at the extending the tax cuts, what we've talked about is it's about 0.5% on average over the next 2 or 3 years of estimated increase in real GDP growth. The baseline's in the blue, the effect of the tax policies here. GDP is over here. and it's pretty clear. GDP up. Inflation is here. This is estimated. This is personal consumption expenditures. When you promote growth while the labor market is fully employed, it's going to be inflationary, and the labor force is pretty fully employed right now. So the effect of the tax policy is likely to increase inflation by a couple of ticks. This isn't tariff related. This is just tax policy. And as a result of the growth, increasing growth, it should probably put a downward, have a downward impact on unemployment. So more people will be working. So again, you got to balance the positives with the negatives. By the way, financial deregulation, if you just take a look at the major banks' return on equity and their capital ratios pre Great Financial Crisis and Basel III. Basel III endgame is where we are now. And if it gets implemented, it will likely tighten lending standards. And if banks need to hold more capital, it means they're going to lend less. And lower credit growth generally translates almost always into lower economic growth. So as a result, what we looked at here, and this is a slide from the prior webinar, what was the pre-Basel II, pre-Basel III return on equity, and outside of the GFC, it was close to 16%. But after Basel III, which tightened up the standards on lending and increased the liquidity necessary for commercial banks in the U.S. to hold, it did totally reduce the return on equity, but it also boosted dramatically the capital cushions. So if you want a safe and sound banking system, you want higher capital ratios, but no, that comes with a cost. So if you get financial deregulation, this is how it's gonna play out. You'll see a higher ROE in the banks. Banks have done very well lately, by the way, as a result. So let's summarize it all, if we can, in terms of what are the implications of the immigration, trade, cost cutting, the Federal Reserve policy, taxes, and deregulation on growth. Well, again, I mentioned most of these came in the first half of the year, and they were pretty much growth negative. These are coming now in the second half and are already being priced into the stock market. They're growth positive. How about for inflation? Reducing the labor force increases the pressure on wages. Trade policy tariffs are going to get paid by the consumers or by companies eating it in terms of their margins. Cost cutting should be good for inflation if it can be meaningful, but we just haven't seen meaningful cost cutting yet because you have to start looking at the entitlements, and no politician's willing to do that. You can't torture the independence of the Federal Reserve. You shouldn't go after the chairman. He's not doing a bad job. He's doing what Congress mandated him to do, and he's quite skilled, by the way, at it. So I would say it reduces the Fed's credibility if they respond to the administration's pressure to lower interest rates. And just by the very fact that you've got, frankly, the Treasury Secretary commenting on where Fed rates should go, that's a dangerous game. It's not helpful. Fed independence helps them do their job better. And if rates, if the Fed is credible, they don't have to increase rates as much when inflation's a problem, and they can decrease rates faster when things recover. So having an independent Federal Reserve is one of the most important things when describing the requirements for the reserve currency of the world, number one. So damaging Fed credibility and, frankly, the reliability of government data and statistics, those are things that are likely to reduce our reserve currency status. So we shouldn't do it. Taxes are inflationary only to the extent that they boost growth while we're in full employment. But deregulation, we don't know. It's probably ambiguous. Could go either way. As it relates to the debt and deficits and debt to GDP, immigration and trade policy, it's kind of ambiguous, but cost cutting should be good for debt to GDP. Again, torturing the Federal Reserve is likely to keep interest rates high, which keeps debt payments high. So that's not good for debt to GDP. Increasing taxes, reducing taxes and tax rates, not good for the debt directly because it increases the deficit. But deregulation should have positive growth implications as long as it doesn't have any negative externalities. You would think deregulation would be positive. So putting it all together, you've got this scorecard. which leads you to, a period where if you can get rid of this policy uncertainty, I mean, in the base case, you're here. So it's negative for growth a little bit, but we're seeing policy uncertainty decline. So that means positive growth, kind of a, mixed bag on inflation, but there's no hope for positive progress on debt to GDP with this current outlook, unless growth overwhelms the negative implications of debt to GDP. So get rid of the policy uncertainty or decrease policy uncertainty, and these things I think are a plus. In terms of what the direct implications are, this is another chart that we presented in the past. When this is on the reverse axis, so this is policy uncertainty increasing as it goes down on the scale here, and the blue line is domestic investment or economic activity. There is a strong link between increasing policy uncertainty and declining economic activity. So you have this massive move in economic uncertainty, but the economies remain resilient so far. It's not likely to come out of this unscathed, and hence our forecast, our cyclical forecast for a whiff of stagflation, that stagnant economy and higher inflation. It's probably going to happen, but it's not going to be horrible. I do want to take a little bit of a detour here. We've talked a lot about macro, but we've touched a little bit on those things that are important for reserve currency status. So here's the BLS response rates, and the next slide is revisions. So there was, I think, a relatively unfortunate incident last week ago Friday, where Erica McEntrefer, as the former head of the BLS, was fired after a disappointing labor market report that showed more than 250,000 jobs were revised away after the preliminary May and June numbers came in. So a couple of things I just want to put a flag in the sand here. There's no way that the data was rigged or manipulated. It can't be. There's 50 PhD economists who are using statistical methods that are transparent, state of the art, and the best at what they do. The BLS, the bank, the BEA, the Bureau of Economic Analysis, they're all staffed with folks that have the best intentions, to be honest. And you can't run an economy or try running a business without good data. If your accountants are telling you that, one thing and the reality is different, it's impossible to run a business. Imagine trying to run the country that way. But let's be honest. And I'm going to make a statement right now. This is really important to know. Everything that's coming out of the Washington, D.C., whether it relates to fiscal policy, executive orders, tweets, et cetera, or monetary policy or pressure on the monetary policy authorities, all of that is a function of the desire of this administration, no different than any other, to retain control of the House of Representatives and the Senate in the 2026 midterm elections. If you put everything we're seeing and hearing, both legislation, particularly OB3, which all the goodies are front-loaded, all the costs associated with them don't kick in until after the November 2026 midterms. The desire to promote a rosy economy, because if you are in a recession, incumbents get tossed out. And right now, the Republicans control both the House and the Senate. It's really important to understand the incentives of the administration and this current administration, and frankly, politicians from time immemorial. Everybody wants to stay in power. How you go about it, changes. The level of aggressiveness that you pursue to stay in power fluctuates, but every politician is incentivized to be reelected. And it's important that we put all of the information we're hearing and talking about today in the context of this broader notion. So what happened at the BLS? Bad number came out. The head of the BLS was fired. Here's why you have such large revisions. I'm going to go to the next slide real quick. Here are the revisions for U.S. non-farm payrolls going back to the last 10 or 12 years. Since COVID, the revisions have increased in magnitude. This minus 258 is a big number, but there were bigger numbers during COVID and at economic turning points. Why are the revisions so big, and what's the deal? The answer is response rates. Response rates have declined dramatically. Here's the one for the current population survey. This is the one that contributes to the non-farm payroll number. It went from 90% 10 years ago to less than 70%. When you have lower response rates in the initial preliminary figure, you should expect that it's going to be revised. I want to make one comment. As a former bond trader, and I've talked to other bond traders and bond managers over the last couple of days, everyone that's traded bonds for a living knows that the non-farm payroll number is a preliminary piece of data and it's going to get revised. But participants in markets appreciate the timeliness of it. Knowing it's going to get revised doesn't make it less useful if it's timely. So there's always this trade-off between timeliness and lower revisions. And I don't understand it. I don't think it was the right thing to do, but no one asked me. Okay, we've seen this chart before. It's about constraints and responsiveness. So far, it's been the markets that have been the most responsive. Congress has been sitting on their hands, and the courts, I mean, wins and losses on both sides. So again, everything comes down to, and the ability of this administration to pursue its policy priorities will be determined by the presidential approval rating and in the context of trying to get everybody reelected that has a seat now in both houses of Congress. The House of Representatives is a toss-up. The Senate is not likely to be flipped. The map for Democrats in the Senate looks pretty bad. There's a lot of data in here on that, but I'm not going to, I may not get to it. Again, in terms of job approval, since the inauguration, overall job approval has declined for the president. Here's the one that probably is most worrisome, is this shift in how folks think about his ability to manage the economy and inflation. Again, these numbers are volatile, and as long as we don't have a recession, I suspect that most people will approve, or more people will approve of the president's handling of the economy and inflation. As long as we don't have a burst of inflation. You saw a little bit of a bump there a couple of months ago, but it's important to keep track of approval ratings because they define the ability of the president to get stuff done. So a lot of big numbers here. Most of them are negative, so more disapproval. We call this being underwater in your approval ratings. This is the big one on inflation. It's the most important thing for the election. And speaking of elections, let's talk about what generally happens in the midterm. Is the president's party loses seats in the House and the Senate. So on average, going back to 1902, if there was a Republican in the White House, the Democrats would lose 33 seats in the Senate, 33 seats in the House, and 2 in the Senate. And vice versa. If there was a Democrat in the White House, the Republicans would pick up 33 seats in the House, and the Republicans would pick up 2 seats in the Senate. So given we have a Republican in the White House right now, the odds are stacked against retaining control of the House, but every single election is different. You got to look at the maps and see what's what. But right now, the toss-ups in the House basically give it's kind of a lean Republican for the House. It's way too soon to tell. We'll be looking at this map for the next year and 4 months ahead of November 2026. But here's where you're not going to see any movement is likely in the Senate. It's likely to retain control. We look at a lot of data here, but I'm going to pass over it for now. In terms of reserve currency status, I'm going to talk just for a minute about what it takes to remain the reserve currency and how we can sort of gauge whether or not we're doing we're benefiting from policies or policies are hurting. I look at the U.S. dollar. This is the dollar trade weighted, and how much dollars are being incorporated into global foreign exchange reserves. That is, other central banks around the world have dollar-denominated assets. They also have euro-denominated assets, yuan or Chinese currency-denominated assets, yen and pound. And so we'll look at what you can see here is that the U.S. still dominates. It's lower than 25 years ago when over 70% of global reserves were in dollars. It's just under 60% now. And more recently, we've seen some volatility in the U.S. dollar, especially post-Liberation Day. And that's what we should expect to see that. The other things that we want to look at are what's the foreign demand for U.S. Treasury securities during the Treasury auctions. And a proxy for foreign bidding is indirect. So indirect bidders here are still strong. So this indicates not much concern that U.S. Treasury securities aren't a safe haven asset anymore. There was a bit of a slowdown here and after April, but not such a big deal. In terms of our net investment position, haven't seen a turnaround there. That's our assets minus U.S. assets held abroad versus U.S. assets or foreign assets held here. Still, the U.S. dominates. So not a lot of information here to suggest that we're doing significant or permanent damage, but little things build up. Julian, is there a question?
Yes, there's a few questions on that topic, and it's really about, as a long-term investor, shouldn't you be concerned about the increasing national debt and the fact that, interest rates, interest payments could be the largest item in a budget. So how do you prepare for that? And is that sustainable?
You're going to have to reformulate. Can you ask me that question again? I'm sorry. I was checking one of the Q&A in the
I guess it's about the concern about the national debt.
Oh, yeah,
and how do you prepare, is that sustainable?
Yeah. Okay. The answer is it is sustainable as long as growth rates are higher than the rate of interest we're paying on our debt, which they are right now. And we expect growth rates to increase. However, we also expect interest rates to remain elevated. So it's a tug of war between those two things. But it's important to remember currencies, debt, our reserve currency status, all of these things don't change on a dime. And especially as it relates to the demand for U.S. treasuries and the U.S. dollar as a foreign exchange currency vehicle, they're all traded relative to other currencies and other bonds that are yielding, in many cases, a lot less than what the U.S. is yielding. So you shouldn't expect sustainability is kind of a fuzzy term. Is there going to be a debt crisis? The answer is probably not. It's going to take a lot more damage. And frankly, the elevation of another currency or another bond market to challenge the US and become a legitimate substitute for US dollar assets. And there's not one on the horizon. We all should remember this is a relative trade. And I use the phrase, we're the cleanest shirt in the US dollar is the cleanest shirt in the dirty laundry. So until such a time as some other country that has deep liquid capital markets, a large enough economy, nobody else can challenge in that regard. Open capital markets, China doesn't qualify. And rule of law, and preferably, democratic institutions, independent Federal Reserve or independent central bank, et cetera. All of these things are absolutely necessary for us to have a debt crisis. But we're watching it by looking at demand for U.S. treasuries from foreign buyers in treasury auctions. Every month there's a 10-year treasury auction, and we can see in real time whether foreign buyers are interested in our debt. So that's what we're looking at. I always focus on the 10-year treasury as the most important price of the world. And right now, U.S. treasuries are trading at 420. It's probably fair. I can't imagine they'll rally a tremendous amount from here. But especially compared to other, and I mentioned this, look, U.S. treasuries yield 4.26%, whereas in the UK, you can get a higher 40 basis points higher yield. But if you bought euro-denominated German bunds, you're talking about 150 basis points lower yield and almost 300 basis points lower yield to go to Japan. Those are the only hard currency potential substitutes. Euro, Japan, UK. And only the UK has got a higher global yield than us right now, which is going to prevent a debt crisis, at least in the near term. Julian?
Yeah, I was going to preview the next slide and ask if gold is the other substitute to the US dollar. And where do you see gold in our portfolios?
I don't in portfolios because it doesn't have a yield, and it's really hard to know when gold is going to rally. Gold should trade, inversely to U.S. interest rates. When U.S. real interest rates go down, gold should go up, but the opposites happen. Gold is trading on a geopolitical risk, and I think on a U.S., there's an increasing risk premium to hold U.S. assets. So I think central banks around the world are trying to substitute away from some US dollar assets by buying gold, and that's causing gold prices to rise. So higher geopolitical risk, concern about institutions here in the United States, some concern, not you know, increasing concern does not equal the death of the US dollar. It just means the hurdle rate to own US dollars has moved up slightly. And as a safe haven, there's been our safe haven status has been dented, at least temporarily, but until there's a substitute that shows up that's legitimate. I mean, if you think about things in the extreme, would you sell all your US dollar denominated assets and buy fill in the blank? What is going to help you achieve your investment objectives better than a diversified portfolio of global equities, US dollar denominated fixed income, and a healthy slug of higher expected return, lower vol alternatives that are generally US dollar denominated? The answer is, Tina, there is no substitute. There is no alternative. There doesn't need to be an alternative. A lot of folks that are trying to sell you a newsletter or get you hyped up on CNBC might want to make a big deal out of what's happening in treasury markets, but I've been looking at treasury markets in granular detail for 30 years, and I'm not seeing anything yet. During the first week of April, there was some indication that there might be some pullback from foreign demand for US dollar assets. But as soon as the rest of the world that's participating in these markets realized that there was no substitute, it's right back to BAU, or business as usual. So I don't have a great deal of concern about it. Other commentators do. Other folks that have been looking at markets a long time highlight the fact that US debt sustainability is a problem, and I totally agree with them. It is a problem. Is it terminal? Is it an existential problem? The answer is absolutely not. So until more evidence accumulates to suggest that we are somehow going to lose our reserve currency status imminently, I think it's just noise right now, and can be safely discounted. I think that's really important to mention. But because we have this we have these twin deficits: a current account deficit, that's the trade issue that's sort of slightly being modified at this point, or the attempt to reorder global trade would help reduce our current account deficit or trade deficit. The current account's primarily made up of the trade deficit. The other deficit we have that we have full control over, that we can't do or won't do anything about, is the budget deficit. So the consequences of sustaining these two budget deficits, I'll just summarize them. They damage the reserve currency status. And there are some bad things that could happen if you do have a sudden stop in our reserve currency status, not even close to being a risk case, let alone the base case. But you would see evidence of a currency devaluation. You'd have much higher inflation. You'd have much higher real interest rates, which equals higher borrowing costs. And that, frankly, would cause balance of payments issues as demand for US dollars declines. So we've enjoyed a lot of benefits. Let me sum up here by saying we've enjoyed a lot of benefits of being the reserve currency, but we have to earn it. We have to earn it. The benefits are structural demand for US dollar assets and lower cost of capital. It's really important that we do that. And now we got to get to AI because we only have a half an hour. Julian.
Well, you already said what I was going to say. I was going to give you a time check, and we have a half an hour, a lot of questions on AI. How do you play AI? What do we think about the implications for the economy?
AI is driving the world right now, and I'm a little late to the AI party. I often try and take on as much information as I can. As investors, it's best not to be the first person through the door, but when there's technological shifts that have significant step changes on the horizon, it's important to get behind them. And it appears that this, by the way, is big tech. This is the hyperscalers' 12-month sales, quarter on quarter. They're $2 trillion. Quarterly sales, $2 trillion. Quarterly EBITDA, $700 billion. Massive margins. Every single quarter, if you add up Microsoft, Amazon, Google, Meta, and Apple's trailing 12 months EBITDA, It's $700 billion. It's unbelievable. This is an important slide. It basically shows the capital expenditures of the hyperscalers and how it's driving the U.S. economy. Good news. Making these investments in the build out of data centers that are necessary to support AI is likely to be a huge productivity booster for the U.S. economy. This is the important point to note about AI. AI in and of itself, good. The ability to increase productivity of U.S. workers, better. And just to put a fine point on it, as we talked about earlier, total factor productivity increases feed right into higher GDP growth. So some of the estimated impact of AI, it's expected to increase productivity by just under a half a percentage point a year, just based on AI adoption into total factor productivity. Again, GDP is total factory productivity growth plus labor force and deepening of the capital. Here's the equation, no quizzes, but the efficiency of the economy is likely to be boosted tremendously by AI. And that is the reason you're seeing such massive growth. And you've seen firms like NVIDIA have, back in 2024 was up 170%. Year to date, it's up 36%. There was a blip on April 3rd and 4th in some of these, the hyperscalers and some of the Mag 7 here. But they're really significantly outperforming the S&P in 2024, up 25%, whereas every single one of these other firms, ex Microsoft in 2024, was up much more than that. So these stocks are driving both the returns of the S&P 500. They're worth 20 or 30% of the returns of the S&P over the last 2 and 3 years, depending on the period you're looking at. So they're really important. And their importance to the real economy can't be understated. If you can get a 40 basis point increase in productivity based just on AI, that's like refrigeration or air conditioning or the steam engine. It's really big. It's really big. However, these stocks aren't cheap. These stocks aren't cheap at all. Tesla trades at 150 times price to earnings or 11 times sales. So whereas the S&P 500 is PE is about 24, depending on which measure you're looking at. Equal weighted, you make these equal weighted, it's less than the S&P actually looks kind of cheap. But if you include all the Mag 7, the PE ratio of the S&P is 24 times. Whereas some of these hyperscalers are trading at much higher than that. But if your growth rates are as high as they are in the Mag 7, then you can probably justify it. Julian.
Just one quick question before we move on to the next section. How do we get exposure to AI? Is it just passively, or do we have any specific manager that we think give you pure play exposure to AI?
It's a really good question. Investing in themes like AI is too narrow, I think, for us to develop an information advantage that can help clients achieve their objectives. I'm all for finding an investment that goes up in price. However, given how difficult that is to know, even if the story sounds good, the investment landscape is littered with surefire thematic investing ideas that didn't pan out. So what I would say is the most important thing, and you talk about it, Julian, in your common sense investing piece, which hasn't been published yet, but I think it's very interesting and very important to note that you can get exposure to a lot of these trends just by having a diversified portfolio of global stocks, not just US stocks, but global stocks. Yeah. And most of the technological advances or innovation is happening in the US. So US stocks have done very well for most of the last 10 or 12 years, but for the last 6 months. That's a different story. I'm just saying the way we're taking advantage of AI is not by getting granular and trying to be thematic about it. We're getting exposure to AI broadly through large cap exposure and broad diversified exposure to companies that are driving the US economy. That's how you do it.
I was going to say one of the conclusions in the piece that'll come out is that innovation comes to you, and a good example is just looking at the NVIDIA being 7% the biggest stock in the S&P. Just by owning the S&P, you would own 7% of your exposure would be NVIDIA, which is the shovel in the AI space.
it's good intuition to highlight that. I mean, you're not just because you don't have an AI specific ETF doesn't mean you're not participating in the information economy, is what I would say. So let's get into tariffs. We've talked a lot about them, so I can breeze through some of this info, and then we talk about the Fed, and then wrap it up after talking about how to position. But here's where we currently stand. It's a nice little map. All of this is in flux, could change tomorrow. China's been tariffs have been put on hold until October now. So, you've got some trade deals reached in the EU, which is the green, no trade deal in a lot of countries. Brazil and Canada are highlighted here. This is a big trading partner. And there's an upcoming tariff deadline for Mexico and China, but those are all going to be pushed into the future. Back in February, we thought the worst case scenario was the average tariff rate in the US would go from, call it 2.5% up to 7%. So this is what we were thinking back in February. This is the history, by the way, of the average rate of tariffs in the US going back to 100 years before Smoot-Hawley in the 1920s, all the way back to the 1820s. There was something called the Tariff of Abominations. Yeah, that was 57%. That's bad. Where do we stand now? This is what we thought we knew. Here's where we're landing, somewhere between 15 and 20%, maybe closer to 20% ultimately when we're done. So if you do get a kind of a 20% or 17.5% tariff rate, that's as high as it's been since Smoot-Hawley in the 1930s. So very high tariff rates. I mean, there's been a period of magnificent U.S. dominance of growth, innovation, and increases in standard of living since the 1930s, in large part because of open trade. So I'm not sure what the long term. I mean, in the short run, tariffs produce government revenue. They probably increase prices. They probably slow economic growth. They certainly slow trade. But in the long run, so it's probably not great. Adam Smith was right. Developing specialties and concentrating efforts is the best way to raise standards of living. Anyway, here's the tariff rates on our top trading partners. 2024 is in the blue. You can see kind of where we've been, and then now is in the orange. You've got Brazil, India, China. These are the emerging markets in red. EU went from 1.3 to 10. Mainland China had a 10% tariff. We're going to 36 probably. That'll be negotiated so that it's effective, I think. So it doesn't cause a trade embargo. We can't have a trade embargo with China. We rely on Chinese goods too much, and they rely on us as a market. Right now, it looks like we're going to get $400 billion annually in tariff revenue, plus or minus. If you get to the levels we're talking about, 17.5%, if that's right. Tariffs aren't all positive. They're not all negative. Like every economic policy you could implement, there's pluses and minuses. The estimated effect on employment, inflation, and GDP is here. It's going to likely increase the unemployment rate as it decreases GDP. So again, and tariffs are a tax on imports, so they cause goods to be cost more. So this combination of these two things is in large part why we think a stagflation environment is likely. A little higher inflation, a little lower growth. And speaking of inflation, just to put a fine point on it, we have seen a little bit of a bump up in CPI core. Headline inflation has moved down dramatically. It's 2.7, but it's kind of stuck there for the last 3 or 4 quarters. Whereas getting from 3 back down to the Fed's target of 2, that's the hardest. That's the hardest thing to do. CPI, not out of hand, not well behaved yet. This is inflation expectations, and this is the more important one. If you're looking at inflation expectations, they're kind of like intermediate inflation. That's for the next 5 years, kind of bumping up against the danger zone. That's why it's in yellow. Whereas longer term inflation expectations, as long as the Fed remains independent and credible, longer term inflation expectations should be, that's okay, 2.25. The longer term for both are just smash packed right on top of the Fed's 2% target. We've been elevated for quite some time here post-COVID, but they're okay. Julian, did you have a question?
Yeah, I mean, a preview on the Fed, but how come the Fed is already planning on cutting rates in September when the CPI is still way above 2%? How can they be confident that they can cut from here?
That's a great question, and actually we'll address it probably in 2 slides. Now that we're T-minus 20 minutes, I should probably get to them. So let me talk about Let me go right there. By the way, we're looking very closely at the labor market. Nick's put together what I think is a great little chart. This is the heat map for the Kansas City Fed labor market data. It looks okay, the labor market. There's some cracks in the labor market, but nothing like what the 250K revisions would tell you for non-farm payroll. Don't just look at non-farm payroll. That's not the only number that matters for the health of the labor market. I guarantee you the Fed's looking. This is the Kansas City Fed metric. The Federal Reserve Board in Washington is looking at this too, not just non-farm payroll. I'm going to make a couple of quick comments about debt sustainability and then go right to the Fed, because the Fed is going to lower rates even though inflation's high. Why can they, or how can they do that? The answer is well, I'll get to that in one sec, but let's just say deficits as far as the eye can see. No surpluses on the horizon. Not since the late 1990s did we have a budget surplus, and we're not likely to see one again. This is very unusual, particularly during a period of economic growth. You should see a budget deficit during periods of recession, because then the government should use pro-cyclical fiscal policy to support the economy by spending more than they're taking in. During a recession, tax revenues go down, spending should go up for automatic stabilizers. That's what should happen. But right now, we have massive budget deficits during a period of full employment. It's not good. And in fact, it's the CBO is projecting that debt to GDP in the US is likely to go close to 150% in the next 10 years. That would be higher than World War II when we were at 120. We're already higher than World War II. So huge debt levels are not good. They reduce your degrees of freedom from a fiscal perspective, and they increase your risk. We're not going to default on our debt. It's not like we're any other country has a potential, I think, to default. But we issue debt in dollars, and we can print dollars. We'll never default. We could inflate our way out, but that's a different story. We talk a lot about government debt sustainability. Why this is different now? Because tax revenues are low. Tax revenues are what they are. The percentage of interest that we're paying out as a percentage of tax revenue is now the highest it's been since before 1992. And that's the problem. This is just this number here, almost 20%, is the percentage of interest expense as a percentage of total government tax revenue received. You gotta change things when this number gets above 14%. That seems to be the trigger point historically. So when you've got low interest costs and low debt, and your interest expenses as a percent of tax revenues 10% or below, you can afford to be accommodative from a fiscal policy standpoint. It's been since 1976 when Congress was last forced to consider austerity. Not going to talk about that. Here's the most important chart when it comes to debt sustainability. As long as real GDP is growing faster than the real interest rate of debt, then and be nice to have a primary budget surplus. That means X interest expense. So you take out interest costs, as long as take it out. That's good. It's easier to get to a primary budget surplus than a full budget surplus. So we don't have to worry about it here because we're the reserve currency of the world. But we should retain our return. We should do what we can to retain our reserve currency status. By the way, Nick and I and Julian always look at a bunch of different scenarios as it relates to debt trajectories, because this is really important stuff. And we vary it based on changes in GDP, changes in inflation, et cetera. It's important. Here's the conversation that I think maybe we need to get to now is what's the Fed going to do? And if you're thinking about what the Fed, how the Fed makes, or the first thing to do when trying to decide what the Federal Reserve is going to do is get a handle on where their current policy stance is. Are they accommodative? Are they restrictive? Is money tight or is money loose? And there's three things you can easily look at to determine what the Fed is going to do. A Taylor rule, which was invented in 1993 paper by John Taylor at Stanford. He's now at the Hoover Institute. Great guy, funny for an economist. It's a model that he created that the Fed uses to estimate the neutral Fed funds rate in a current environment. Uses output gap, uses the current rate of inflation, a couple of betas, and a real rate and an R star. And it's the neutral nominal funds rate is what this purports to help identify. If Fed funds are positively real, or that means they're restrictive. If they're negative real, then they're probably tight. And you want to look at where current Fed funds are versus R star. So gauging where the Fed currently stands is the starting point to understanding where they're going. So the reason the Fed can lower interest rates now is two things. One, all of these measures indicate that they're restrictive. So they do have room to and scope to lower interest rates. And the second thing is the Fed manages interest rate policy on a go forward basis, not on a current basis. So the Fed economists who are forecasting inflation have in their models that inflation will, in the next 3 or 4 quarters, return to something close to the Fed's 2% target. That allows them to lower interest rates. By the way, just because you lower interest rates doesn't mean that you're putting upward pressure on inflation and rates. If you are restrictive, that is, if the current rate of interest is higher than what these three metrics determine is the appropriate level, then you are tight and you are restrictive. So you can lower the level of restriction. You can reduce the restrictiveness, still be putting downward pressure on inflation and rates, and have a rate cut, which is what's going to happen. So rates should go down because the Fed is so restrictive that these models, which incorporate some at least Taylor rule, incorporates a little bit of forward looking. You can see here that, by the way, the Taylor rule is basically saying you should do 2+ rate cuts, 60 bips. So the Taylor rule is saying 2 rate cuts. The real Fed funds rate should normalize. This should normalize at something on the order of like 1%. So that means, again, at 158 basis points, you want to go to 1%. Okay, that's another 2 rate cuts. So at least 2 rate cuts are available to the Federal Reserve right now, just based on the Taylor rule and an analysis of the real Fed funds rate. And looking at the nominal Fed funds rate, just how tight is monetary policy? Well, we're at 4 3/8 right now. That's the mid range, 4.25 to 4 to 4.25 right now, 4 to 4.5. So 4.25 to 4.5. That's where we're at. We've had 4 rate cuts. The peak was 4.5, 5.5. We're down to 4.5 on the upper end, 4.38 mid or 4.3875 mid. Where is our star? That's the real challenging question. People kind of know what the Taylor rule is telling you, and it's relatively easy to calculate the real Fed funds rate, but determining where our star is hard. We don't know. But it's lower than 4 3/8. So if it's 3 7/8, then you've got, again, 2 more rate cuts. So basically, the entire analysis suggests that all 3 of these metrics are pointing towards the Fed's current policy being restrictive, which gives them the scope or the degree of freedom to lower interest rates. So what are they going to do? What's the market telling you they're going to do? A rate cut on November 17th, another 2/3 of a rate cut or 3/4 of a rate cut in October, and a full, rate cut and a half by December. So basically 2.5 rate cuts by the end of the year. So I'm just going to say 2 or 3. Yes, Julian.
I was going to preview the final section, but so if the Fed is currently restrictive and going to more neutral policy, is that a reason to be risk on and bullish?
It's not the only reason, but one of the significant contributors to equity market returns is interest rates. And lower interest rates are good for equity markets. Lower interest rates are good for real estate markets. All risk assets should benefit from a lower discount rate, which is interest rates and spreads. So yes, I mean, we're bullish, we're risk on. And we're risk on because of the potential tailwinds to the US economy, the potential for Fed rate cuts, the low probability of a recession in the next 2 quarters. And that's all a function of some of the policies. The bad policy news has gotten out of the way. The good policy news is on the way. And again, the willingness of this administration, just like any other, ahead of the midterm elections, to goose the economy in any way, shape, or form they can. They'll do it, and they'll do it, which keeps me feeling pretty good about taking on risk between now and November of next year, because of this increasingly, high likelihood that fiscal policy will certainly be pointed at supporting the U.S. economy and labor markets. Monetary policy looks to become less restrictive and maybe neutral in the next quarter or three. And if that's the case, maybe some of the clouds are starting to lift on the uncertainty. I don't think we've seen the end of the volatility. I'll just say that. I just think and should the administration announce a policy that's likely to be really negative for either the economy or markets, I see them pulling back on it. So that's key. That's really key to know. What we have to do here is ignore some of the noise and find the signal. And the signal is the administration wants the economy to be humming right along through November of 2026. Monetary policy looks to become a little more accommodative, not accommodative per se, but less restrictive. There's no recession on the horizon in our view. All of those things point to being risk on because the stock market almost always goes up, by the way. Is it going to go up for sure? No. Is there going to be bouts of volatility? Yes. Have we seen the peak of the volatility? I think yes. I think we've seen the peak of the volatility. It's not going to mean that we're not going to see bouts of volatility, but it's going to be hard to get back to April 3rd, 4th levels of vol. That's likely to be the peak. I think the economy's, and we think in the investment committee at Beacon Point, the economy is likely to dip below trend and then recover. Just actually, blue chip has come to us now. We've been thinking about this for a couple of quarters. Inflation is good if you're trying to get the debt levels down here in the U.S. And I think the Fed will likely let inflation run. They won't do it on purpose, and they're never going to say it out loud, but they're likely to let inflation run at 2.5 instead of 2. That will supercharge debt reduction, and it's another reason. It's kind of a financial repression tactic, which is our secular theme. It's another reason why I'm a little more sanguine about the environment. And I think the environment's going to allow the Fed to cut rates. I want to say 2.5 times. That's what the market's telling us. I do think they'll cut rates in September, unless you get a blowout inflation number for September, because we'll get that right before the Fed meeting, the FOMC meeting on September 15th. We'll get a number on September 12th, I think, plus or minus for CPI. And if that's true, then it's important to just remember that policy uncertainty remains, but it's not as opaque as it used to be. Julian?
Yeah, let's talk about how we position by asset class, equities, fixed income, alternatives in this environment.
Here's the overall risk taking. We're risk on. We were slightly risk on 2 quarters ago. We're risk on now. And what that means is, quantitatively, we're 2/3 of our risk budget or 60% of our risk budget, plus or minus. That's kind of how we calculate it. We're not fully risk on, even though we have a sanguine outlook for the economy and for corporate profits, in large part because when investing, it's not just getting the direction right, it's your level of conviction in getting that right. And there's absolutely no way, and I think someone mentioned it in the Q&A. No, Phil, no, I didn't talk about the PPI yet. I'll come back to that in a sec. The idea, or we'll take that offline actually, the idea that you can make a judgment about where to place your bets for risk assets is the scale of your decision to add to risk has to be connected intimately to your level of conviction. And while I said policy uncertainty is lifting, it was completely opaque 120 days ago. So it's becoming a little less opaque. That's helpful, but it doesn't mean you should go all in on risk for sure. And never should you go 0 risk or 100%, or you'd be more than 100% risk. You need to moderate the decisions that you make in an investment portfolio to reflect the fact there are unknown unknowns. There are things out there that we don't know are going to happen. And besides, you don't have to go risk off or risk on to achieve your objectives. You don't. You just need to nudge the portfolio around when it seems like it's a good opportunity to take a little more risk and try to protect capital in the portfolio when things look wildly stretched and you don't have a thesis that suggests that market and economic data are likely to be revealed that will support these record levels of the equity market. By the way, just because you invest at record levels doesn't mean you're likely to underperform Folks, over the long run, it doesn't matter when you invest. Get fully invested. Stay fully invested. Nudge the portfolio around a little bit. Take a little bit of equity risk in large cap core, value, and international. Be neutral to growth because you don't know how far that can run. Underweight mid cap, just because it's done, although mid caps are now seem cheap, and last week or so they've rallied tremendously. In the long run, I just think larger companies are where it's at, particularly if that's where, AI and growth and the Mag 7 are. We're not overweight growth because valuations don't argue for that, but we're not underweight either. And importantly, we're going to fund our slight overweight to risk assets, or our overweight to risk assets with bond by reducing our bond market risk, which is highly consistent with our views that while inflation may not get out of hand, this extra premium that the market is demanding for 10-year treasury yields or longer duration treasuries is likely to persist. It's called the term premium, and it's a function of supply and demand and inflation, volatility, and a bunch of other things. Long-term yields are likely to remain elevated, while short-term yields are likely to decline. And that is just another way of saying the curve is going to steepen. So the economy looks to be remaining resilient. There is some tailwinds from OB3, but there's still uncertainty out there. But everything taken together leads me to believe that taking a little bit of risk is going to be appropriate. And by the way, it's more often than not, you are rewarded for taking risk. I love the bull market chart here, going back to the 100 years ago. Bull markets create wealth. Bear markets are these short periods with drawdowns that can be large and feel horrible at the time. Similar to kind of this what happened in 2022, down 24%. That felt horrible. But if you stayed invested from through the knots and the teens, and then stayed invested after, I mean, we're up 80%, almost 80%. I think it's a little higher now if you go through. This is through July 16th. Add another month, and you're almost to 80% here in terms of the current bull market. You got to stay invested. The stock market goes up more often than not, so taking a little bit of risk is almost always rewarded. And with that, I'm going to just suggest that maybe we recap on some timeless investor wisdom. Some of the things I've tried to weave some of these thoughts into the conversation so far. If there's any last questions, please get them in. But the most important thing you can do based on that chart I just showed you is take a long-term approach. All of these wiggles in the markets, they're kind of random. Even April 3rd and 4th seem random to me now, while it seemed horrible at the time. By the way, we went out and bought stocks at the close of business on Friday, April 4th, because that's what we were supposed to do. You're supposed to look at the volatility and create because it creates an opportunity for clients in many cases. That's our job. That's what we're paid to do, is do the hard thing, buy when everyone's selling. So take a long-term approach. Get a diversified portfolio, including international equities, because sometimes international outperforms the US. You don't know. We don't know. Our expectation is the US dollar is going to decline. That would be good for international. And don't think about individual strategies or managers. Think about your overall portfolio results. That's how institutions think about it. It's a portfolio level return that matters versus the benchmark. And know that we're using state-of-the-art risk modeling tools here. So identify your investment objective, stay invested, and build that in a portfolio that actually achieves your objectives, and know that risk modeling is the thing that keeps us in the game. So don't be worried about volatility. It's the price you pay to build wealth. Any other final questions, or do you want to close, Julian?
No other questions in the chat, no open questions. So I guess we can close this webinar. And thank you, Michael, and thank you all for joining us today. We appreciate your time and engagement, and we hope you found today's webinar valuable. So keep an eye on your inbox for an invitation for our next quarterly update, which will take place on December 11. We look forward to seeing you then. Until then, à bientôt.
Thanks, everybody, for joining. Take care. Bye now.